You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, we're back into the swing of things in 2023. We've been looking at a lot more neutral trades to the market. We did a directional butterfly. It actually kind of worked out. It was a very short-term speculative butterfly to the downside in the S&P 500 index a couple of weeks back. This week, or last week, I should say, on the 12th, we looked at an iron condor in the SPX S&P 500 index. Now, part of the reason why we're looking at these strategies in this big index, the S&P 500 index, is that direction is pretty tough right now. And just flat out buying stocks has some headwinds. Should I look at some value? Is tech beaten up enough that I might want to buy some tech? When do I want to dip my toe in the water and actually jump in and buy some stocks? And there's a lot of mixed feelings in the marketplace. I feel like this week was the first week where you hear a lot of the pundits on all of the financial shows saying the soft landing is still out there. That possibility, considering some of the CPI data, some of the other economic data that we received over the last week, is just kind of leaning towards that possibility. And, we're seeing China come back into the fold. We even saw oil go up mainly because they're expecting increased demand in China because their economy is coming back. So I guess overall, I would say that the news is good. The SPX still is really struggling to get above the 4,000 level, and hence the reason why we looked at an iron condor last week, and that we're just looking at a neutral trade where we flat out went equidistant in and out of the money, almost exactly equidistant. We leaned a little bit more on the put side. The markets do have a tendency to go down a little faster, so we went a little bit further out of the money on the put side. But the market really hasn't moved since last week. So let's just look at that trade really quick. We are going all the way out till February 3rd. And once again, when we looked at putting this trade on, it was the 12th of January. Those February 3rd option contracts now have 16 days to live. And the S&P 500 index, when we looked at the trade last week from my screenshot, was at 3971.72. I'll say that one more time. The market was at 3971.72, 3,971.72. And so we went and looked at the February 3rd expiration, sold the 1,420 strike call, Our protection was to buy the 4,130 strike call. So our short call spread in the iron condor was selling the February 3rd 4,120 strike call and buying the February 3rd expiration 4,130 strike call. Now that's a mouthful. So on the downside, when we were looking at the puts, we looked to sell the 3,815 strike put and then buy the 3,805 strike put. Now, market was at 39.71. We're fairly close in the middle. Concept was that we knew 4,000 is a little bit of a tough range, only because it's a nice round number. It's not necessarily, if you look at the chart, an area of resistance to the upside, but those round numbers always seem hard for indexes to break through. And then we just leaned a little bit more on the downside and hoping that the market stays between our short put and our short call. We got it done at a midpoint price of $3.80. That's $380 net credit we brought in for every one by one iron condor that we put on. All right, so cut to the chase. Market hasn't done anything. I'm not going to adjust this trade. We'll probably come back and look at it next week. But we sold it for $3.80. Right now, that trade, if I pull up a quote, the markets are closed. We're doing it on a Wednesday. The date today is the 18th of January. And the midpoint now on that trade is $3.05. So we've made 75 cents on the trade. I don't know why we wouldn't stay the course. There's nothing that's happening right now in the marketplace to make me think that the market is going anywhere in a hurry. So I would definitely stay the course, at least try to get one more week of time decay out of this trade before I would consider closing it. But great example. The market right now is $3,928.86. That's where it closed today on January 18th. And with that said, we got 75 cents worth of time decay, basically. So 1 week of time premium, even though we went further out in time, you still get a lot of decay in the option contracts. The VIX is still hanging right around that 20 level, just below it, which I do think is significant that it is. It's actually with the downturn at the end of the market, it's now at 2034. But I do think that line in the sand on low volatility is 20%. So it was nice to see the VIX actually break through that and trade below 20, showing a little bit of the anxiety coming out of the marketplace. But 20% volatility is definitely justified considering the economic conditions that we have going on here right now in the U.S. All right. So this week, we're going to do a FOMO trade. Today, we heard a lot about the airlines and a lot of hype about the fact that consumers are still willing to spend, that they've been cooped up and they're ready to do some traveling and see the world again. And so a lot of good numbers in the earnings front from a lot of the airlines. And so this week, we're going to actually run out and look at an old favorite of Warren Buffett, which is Delta Airlines. I know that he's bought and sold Delta quite a bit. I still think he might have some in his portfolio. But with that said, if we're going to do a fear of missing out trade, it means that, okay, we're going to dip our toe in the water here. We're going to go further out in time, and we're going to buy a long-term put option. Like I mentioned, the airlines are in the news. They got some good volume on a lot of the airline stocks in the options marketplace, and that's really important when you're looking at longer-term options, and in particular, deeper in the money longer-term option contracts. So we're going to go out to the end of the summer, hope that the economy stays afloat, that we do kind of have that soft landing, because that, if we did go into a full-blown recession, that would be bad for airlines. It would be bad for the whole market, but airline stocks would definitely get beat up. They are not recession-proof, that's for sure. And if we're looking at that market going all the way up to September 15th, 2023, 240 days away, going through the summer travel season. And if we look at this, the 32 strike call option with Delta trading at 38.38, exactly 38.38 is where it closed today, is trading $9.10 by $9.30. Like I mentioned, the markets are closed. So we can go out and get an 80 Delta option contract, buy the 32 strike call option. I don't know if you could work the trade, but we'll just say that we're going to pay the ask, because if we pay the ask, we still only have a 20-cent wide spread, but which on a percentage basis, that's fairly big, but it's not bad for longer-term option contracts. And we're paying $9.30. We'll buy one call option as an alternative to buying the stock outright. That means our risk will be $930 plus commission to put that trade on. We'll have something that gives us a lot of stock price representation, trading with an 80 delta. That means every time the stock goes up one, our option contract should go up about 80 cents in theory. And then we pick up deltas as we go up. If we go from 38 to 39, we will see the delta of our option contract slowly approach one. And on the way down, we get a little bit of a buffer, right? So we've always talked to that if we're doing the longer term option strategy, we always want to pay attention to the strike price. So if the stock did come from 38 all the way down to our strike of 32, we want to consider getting out at that point in time, because we've already reduced our risk quite a bit to buy, as opposed to buying the stock outright. Instead of paying $3,838 for owning 100 shares of stock, we're only going to put up $930. That would be our maximum risk on that trade. So in this instance, if the market came down towards that 32 level, that would be considered an at-the-money option contract, and we would want to exit our position and try to grab as much juice as we could from that option contract on our trade that has gone awry. We were wrong about our forecast. Maybe a recession is happening. Something is, people have all of a sudden completely changed their minds and decided they didn't want to travel anymore. Those type of things could be happening. Okay, so very simple, very straightforward trade. I would classify this in my list of FOMO trades. We're going to look at the airlines. Good numbers came out from the airlines. They do not see that waning at all. So how can we participate in the airlines without all the risk of actually buying the stock outright? So it's important to emphasize that if we were looking at buying 100 shares of Delta Airlines, we're going to go out and buy one option contract, which represents 100 shares of stock, gives us some stock representation. We're going deeper in the money, so it acts a little bit more like a surrogate for the stock, and we're going to limit our risk by doing so. All right, so that's it for this edition of Options Playbook Radio. If you have any questions you'd like to ask me, please email them to me at theoptionsguy@invest.ally.com. If you'd like to learn more about all the educational events that I do over here at Ally Invest, please just follow me on Twitter. My handle is @BrianOverby, very simple, at my name. And thanks for listening. Until we meet again, may all the option contracts that you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.